Alright guys, so I'm going to get straight into it with this video. No fancy edits or cuts or nothing like that. I want to talk price action today and purely trading. Now, I'm going to give you something valuable, or a lot of things valuable, to walk away from this video. I'm not one to clickbait you into stuff and talk a lot about nothing. You'll see that for yourself. Now, Twitter. I've been seeing a trend on my Twitter over the past couple of weeks. If you don't already follow me on there as well, I will put a link in the description so you can do that. Of people taking long positions on the NASDAQ. And I had to rub my eyes for a minute to double check if that was real, and it unfortunately was. I mean, all you got to do is go on the daily, get a ray line tool, and plot on the all-time highs, and just look at this with a bit of sense, and ask yourself, why would you entertain any position, long or short, up here? Why? That's like buying BTC at its highs, or all-time highs even, or even past all-time highs. You wouldn't do that. That's not a smart move to make. Now, location and positioning means everything in trading. If you don't know where you're situated on the higher time frames, and by higher time frames I mean the dailies and weeklies. People have got their own interpretation of it now. Oh well, my higher time frame is the 4 hour. That might be your macro outlook, but that's not actually considered a higher time frame. The true higher time frames, let's not forget, are the dailies and higher. This is just basics, but people love to put their own interpretations on these things. If you don't know where you're situated, the risk that you bring on your portfolio is going to be scattered. It's like, for example, if you look at a property in Manchester compared to London, the same house, same exact 4-bedroom, detached house or 2-bedroom apartment in the city, it will be priced differently because of the location. Location determines value, especially in the markets. So nobody can sit here and tell me, it doesn't matter how you trade, that where you position in the market doesn't really matter, because it does. Trades that shape up in here can have the same exact makeup as trades positioned lower down here, but the risk that they bring will be entirely different. And if you're not factoring this into your trading, the way that you trade may be like sinking on a ship, per se. Or sorry, being on a sinking ship. Let me rephrase that better. Okay, and so you don't want to be in that position as a trader, because then you don't know how long your edge is actually going to last in the markets. You want to trade in a way that tracks the higher time frame movement, that tracks the higher time frame money flow. This is very important. Otherwise, you'll always get left behind, or you'll have these periods where you do well, and then you'll have long periods where you don't do well. For example, January. Another thing that I won't cover too long here, I want you guys to go onto my Twitter and see the videos that I made regarding this, but January was considered by many people a very poor month to trade. Now you see, this is the problem. When you don't phrase things correctly, people take them literally. Other people may look at that and think January as a whole for every trader is a poor month to trade, but it's not. I finished 8.9 for the month. A couple of students in our community finished double digits in the month, whereas other traders may have finished -2 or break even. This is a matter of the markets gelling with the way that you trade in that particular time period. There'll be months in this year where I might be break even or might be in slight negative, but it doesn't mean that that's a poor month to trade in. Alright, but I've covered that on my Twitter anyway. So going to the NASDAQ, now there was a position that one or two of the guys that I coach actually took. So these are all-time highs, and that I would have actually taken, but I didn't have the NASDAQ on watch that week. So let me just show you these highs. They'd been broken, right? Now, after they'd been broken, I'm looking at it from a market psychology point of view. Price sold off, but it didn't form follow-through continuation structure. So if it didn't do that, then why is it climbing back up again? And it's not just the fact it's climbing back up again, it's how it's climbing back up. See, people always trying to track the why in the markets, but not the how. What is the characteristics within price nature? So you'll see here, price reverses, it turns around, it forms a larger continuation structure like so. Okay, the lows are broken, price snaps back in. After it snaps back in here, there's a follow-through continuation within that. It's a very simple trade, textbook trade. And again, I didn't have it on watch that week, otherwise I would have taken it exactly like I'm showing you now. And there actually is two ways to take it. So there's a stop order way, so you can put a buy stop here and take the entry like so. Or you could have actually executed via this retrace candle that we had form. I think it was around 5 in the morning. Yeah, about 4:45 in the morning. But even again, you could have set a buy limit if you just missed it, and that would have triggered you in regardless. But nonetheless, stop loss, probably about 7.5 pips below this wick. Management, very simple. And again, to make matters worse, which I'll show you on the charts in a second, these trades that I'm about to show in a second, the ones that I wouldn't take, that are already poorly positioned, the guys that I was looking at, they were getting out for 2 to 1, 3 to 1. I want to make something clear as well. I'm not trying to shit on anybody here. I'm not trying to put anybody down. I actually want to help all of you watching this. I don't gain anything by putting this video out, but I like it. It's like an OCD of mine. If I see something that I know can fix somebody's trading, I'll put it out there. Now, many of you may fail to comprehend that, and you might think that there's some sort of malice intention behind this video, but not everybody's got bad intentions. So this trade, this is the range I'm looking to play, and the first initial inflection point is the start of this structure, the start of this continuation. So I'm going to manage it based off of worst case scenario. What could I have walked away with? Now, this trade from a management perspective would have been very simple. And again, I'm not nitpicking or hindsight trading here. I mean, technically I'm hindsight trading, but I actually would have taken this. A lot of people know, who know my trading within the community, that this is a textbook trade for me. I just didn't have it on watch. There was a couple of guys, if I can attach screenshots with blurring their name out as well for their privacy, I will do, to show you that they actually took this trade. Similar entry to this, and they walked away with around 11%. So yeah, this trade would have got me out for 11%. Now, another thing for management that will help all of you. If I know I've set my take profit up here, so I've got break even, I've eliminated risk. How I see some people manage trades is they will set a target and they will say, I either reach the target or I get taken out for a break even or a loss. That's not smart. Remember, there's two main goals and objectives in trading, which is what? To lose as little money as possible and to make as much money as possible. We can't overcomplicate it more than that. How you do that, that's up to you. But you need to make sure you do it in a sustainable fashion. And that's the ultimate objectives, two objectives in trading. If I know I'm running at this point, let's say there, 7%, why am I going to leave 7% on the table? Why won't I just lock in, say 3.5 or 4%? Based off of structure. So you can't just guess this. There's a way to do it. We teach our students this, right? I can't obviously walk through it in this one video, but there's a way that we teach trail stops effectively. Whereas if a trade's running 7-8%, we're not just going to lock in at break even and then leave all that profit on the table and then get taken out for a break even. That's not smart. You don't grow your account that way. Anyway, this would have taken me out for, again, 11 to 1, very simple trade. Now, going to the trades here that I'm talking about. Have a look at this and just look at it with common sense, guys. I don't want anyone to get hurt by this video. I don't want to upset anybody with this video. I'm just trying to help you understand and learn something here. It doesn't matter how you trade. And I'm using the term ICT here because, not for clickbait, not to get attention, because the traders that I've observed, they fall under that category. Now, I'm not trying to mock ICT's teachings here. I don't want to, again, it's not worth arguing with some fools as well, because I lose my own brain cells by conversing with people who are not willing to learn anything. But the traders that happen to fall under the category of traders who took positions here happen to be ICT traders to whatever spectrum, because I know he's got like 150 different concepts. I don't know how many. So people like to choose one out of like hundreds of concepts. I don't know. Whatever end of the spectrum you fall under, that's what I observed. Okay, that you're getting out in here for 2 to 1. Why? When a position has a range to play of a 10 to 1, why do you not maximize your profit? And that's got nothing to do with me saying trade the way that I do, otherwise you don't know what you're talking about. I'm just trying to help you understand a universal law in the market. Anyway, getting to the trade, or the first trade even. So this is what I'd seen on my Twitter. I think the individual's on a 5-minute chart for management and 1 minute for entry, if I can remember correctly. I'm not too sure. Price sold off. Now, if I'm going to be looking for any kind of long positions, the minimum I want to be looking for is from this area. So even then, price hasn't even met a great area. And it came and it formed these equal lows that you can see there. Price pushed higher and we formed this. Now, we call this a hook point, but there's many different names for it. Some of you might call it a liquidity point, or I don't know. I don't specialize in labeling things. I specialize in looking at price behavior and price patterns and studying that and trading that. I couldn't care less why something happens. I've never been too bothered about trying to dive into all the different layers and details as to why all these things happen in the market. I've got a very basic understanding of who moves the market, but frankly, I couldn't give a shit. Mind my language. All I care about is if I can see repeatable price behavior and price patterns occurring, and I can trade that in a sustainable fashion and maximize my profit and minimize my risk, That's all I'm bothered about. You know, whether it's a monkey moving the market or some crazy robots, I don't care. Okay, and I don't think anybody should be spending their time or wasting their time trying to figure out what that is. It's actually completely irrelevant when you really think about it. So price comes in, taps these equal lows. Again, this is a poorer inflection point. So this is the minimum we're looking at, and then this one's been met. See, price levels are like magnets a little bit. Price will always gravitate towards, in the end, eventually, or statistically speaking here, let me use a better word there, towards the areas in which they have more volume. So if, for example, you've got one set of highs here and two set of highs, so we'll call this A and B, price will normally stop at point A as an inflection area to then pull back and trade towards point B where there's potentially more volume. Price is always trying to find better priced areas. Again, like I talked about with location. Location determines value. Anyway, it comes in and then we form this small continuation into a slightly bigger one. So let me go to the 5-minute chart and show you this trade. So if I would have even entertained this trade, this is how I would have taken it. Price comes into there. This wouldn't have even been a 5-minute entry. It would have been a 15-minute entry. And I would have played this based off of a 1 hour 50% limit order entry, which is one style of entry I like to take in certain scenarios. For example, when the risk to reward on the break of the body is not healthy enough, let's put it that way, then I like to play that on a limit order to get a tighter entry and a more protected stop. That's only in certain conditions though. Okay, let me mark this on as our inflection point, and I can actually crop my stops just beneath that. So again, roughly about 7.5 pips. That wick's pretty much irrelevant. I'm looking at it more from this line. How would I have managed it? Now, the individual that I had seen that had taken this trade had a slightly bigger stop, like 8 or 9, nothing too crazy, but he got out around here for like 3.5%. How I would manage this trade, again, it's the same mechanical management process. First inflection point to the range, to there, 90%, that would have got me out for 10.5. I've done nothing different. Any Falcon student that's watching this, please comment down below. I actually urge all of you Falcon students to comment down below and reiterate what I'm saying, not for the sake of it. If you disagree as a Falcon student, also put that down. But I want all of you guys know who are in our ecosystem and trade how we do, to please confirm for everybody else that everything I've broken down here applies and follows the same concepts that I always speak about on any trade, on any pair. Like, nothing's different here that I've used. So please confirm down below for everybody else watching that I've not just nitpicked a trade and randomly picked an entry. Everybody knows this is a very consistent entry of mine. This one here, right? 3 touch into a 15-minute hook point, 50% limit order play. All of you guys know who trade Falcon, who watch my webinars, right? Who understand how I take certain trades. This is very consistent with how I trade. So nothing's different here. But you all know that I wouldn't even entertain a trade in that area, first and foremost. But if I was to, I was just comparing to see what would I get out of? What does my system have in terms of potentiality? So that's trade number 1, right? 10.5%, price reversed. Let's fast forward this now. There was another trade. I may cover this in a different video because it's getting a little bit long. But this was a 1-minute trade. Now, we don't even use the 1-minute time frame. But I thought, you know what? Let me actually test to see, because the second trade I saw was from another individual. I won't name names here because I don't want to ruin anyone's reputation, or even try and, you know, tarnish it or anything like that. I'm not interested. But I saw the trade and he took it on the 1 minute and he got out for a 2-to-1, bang on. And this trade would have got me out for about 7-to-1. So what happened here? We have these lows, price dipped beneath, accumulated all this volume, it sprung back up again. So we're looking at these highs. Now think about it. Like I just spoke about, if price has near missed these highs, where do you think it's trying to target next? Now, I would have had the same exact thought process if price was down here. I would have said the same thing. It's looking to either meet these highs or take them out. It's just took them out there. Okay, same concepts. What can we see? Continuation pattern. Again, people who think we just trade flags. By that logic, I would have taken a loss here, but I didn't, because we don't just trade flags. There's a specific way that we take continuation or reversal structures or patterns. What's happened? We didn't actually get an entry candle form. We've pushed higher. We formed a flatter continuation. We broke beneath. No trades again. Now, if we go to the 1 minute, considering I don't trade this time frame, okay, what's happened? We've broke back higher. Where have we actually retested back to? So let me go to the 5 minute to show you something. Some of you may have a term or a concept of this. I don't know what this is. This is just, again, repeatable price behavior that I'm repeating back to you. What's happened? You see left, continuation, snapped through. Where did we come back up to again? Here. We had a lot of volume come in here. Price has broken out. It's formed this, snap beneath, and it's retested the back end of that. So that's the confluence that I'm using there. Okay, same, again, consistent confluence. Same pattern here. This is even on the 1 minute. I know some of you Falcon students might be laughing to see the consistency of how we trade across all time frames present. Same entry. Retrace candle. This is not broken and closed below the low impulsively, which is one of my criteria in my plan. Stop sizing. So again, you can get in with about an 8 pip stop. Nice and protected. Management wise, how would I manage this? So to the highs that I've got marked on, same principle again. Down to here to the lows. 90% of that range. Okay, considering I'm managing on the 1 hour time frame. That's the strict criteria that I have. And as you can see there, if I just remove this and show you that we're doing a very quick move for, again, 8.5%. So there's 10% there, roughly. There's 8%, there's 18%, plus another 10%. That's 28 or 30%. But most of the guys that I see that are longing NAS 100 and even the most poor areas are only getting out for a 2 or 3 to 1. So you're bringing all that increased risk on your portfolio only to gain a 2 or 3 to 1. And when I see these videos, by the way, and again, you can trade how you like. I'm just trying to give you all advice here and trying to help everyone out. I'm not trying to shit on anyone here. They've got so much going on in their charts. Zone after zone and hundreds of different things. I can understand why you now think trading more than one pair is stressful, because if I was to trade that way and I was trading more than one pair, I'd get stressed out. Let alone then if you're managing millions of dollars of investor capital, you would get stressed out. There's a reason that we can trade multiple different pairs out of this watch list here, and we create a top 6 and a set of additional pairs, of which we have 2 or 3 in watch every day at most, right? We don't have 10 or 15 pairs on watch in a day. We might have 10 pairs in total in our watch list that we refined, but I'll be looking at between maximum 4 pairs out of those a day, maximum. Most of the time it's 1 or 2. There's a reason I can do that without any stress in my trading, and I can manage that. But there's a reason that most of you guys can't even trade more than one pair, because you trade in such a stressful way. So I hope you take something away from this video. Alright, I'll recap on some more positions. I want you to make this video raw, unedited, no filters, nothing fancy, just straight price action talk. And give me a follow on my Twitter if you haven't already. I'll be keeping more videos coming. There's a few videos coming over the next couple of weeks as well. And yeah, stay tuned.